These 10 rules are the reason my trading went from inconsistent and frustrating to predictable and profitable. And I see it every day. Traders who follow these rules level up, while those who don't keep struggling. So if you're a serious trader and you're about getting funded and making money and making trading work for you, then make sure you watch this video to the end, because the last lesson I'm going to share with you is the most important. Now, the first one I want to talk about today, guys, the first rule is set a target and hold your trades. If you have a target in mind, trust it, because exiting out early of fear means that you're effectively cutting your winners short. So you've got to let the trade play out and you've got to stick to your plan. And this is a trade that I took today on the London Live with NDS. And you can see we hit profit on this 1.5R. So I'm not being ungrateful here. But I do want to say this to you. As you can see, it clearly continued to the downside. There is one thing that I can't stress enough, and that is closing your trades out too early. The reaction from closing trades too early causes so much FOMO, so much revenge trading, so much jumping into trades that you shouldn't be jumping into just to get back the profit you could have made. Taking reversals, anticipating price to turn around because now you've closed a trade because you thought it was going to turn around, and then you enter and then it continues down. All of those reasons and probably many more. But this example here is a fine example of setting a target and holding your trades not done effectively. Because when I entered this trade, the idea was price had been pushing for 2 candles here on the hourly time frame. What had happened is we saw that USD was showing signs of weakness across the board this morning. So when I looked at USD JPY, I could see that price had already flipped bearish. That didn't necessarily mean that yen was strong. So if I'm looking to sell euro yen here, then I'm looking for yen strength and euro weakness. Let's just call it yen strength. At the time of this trading idea, when I looked over at USD JPY, it already left. It already pushed to the downside. So that was illustrating yen strength. When I looked at pound JPY and euro yen, it was just sitting in around a consolidation area. Okay, what's the time now? Yeah, so it was sitting, not consolidation, it was sitting around a small bearish indecision candle. About a minute later, I looked at pound JPY and I could see that price had started to push bearish. Now, there wasn't a low to be broken here, so I couldn't enter the trade. But anyway, I looked over at euro yen and I could see that price had pushed bearish, created a lower high, and then had an area for me to enter the trade 3 minutes into the candle open for a selling opportunity. So we executed the trade. Now, that's the execution. The idea behind this trade was to hold it at least to 1R. Now, the reason I say that is because we already taken a gold trade this morning. We already hit 2R. So if I'd hit 1R, would have made 3R for the day. But that's not how you should approach your trading. You should say to yourself, I'm entering this trade and this is my target and I'm going to hold it. So the thought process was, okay, I've entered the trade. I believe price could come down to this wick area here. So if you look on the 1 minute time frame, it's this area here. Then I went over to the 4-hour time frame, and on entry of this candle, it was around here. Okay. Yeah, it was around here. And it was an indecision bearish for our candle with a top wick. That threw me off. In my head, I said to myself, price can't push down anymore. It's already gone from being bullish to bearish. It looks like it's jumping up and down. But, you know, it can't go down anymore. Now, if you look at my crosshairs and you look over to the 1 minute time frame, you can see that's why I exited the trade. So that had an influence on my decision to exit the trade. I went back over to the hourly and I said, price could come back down here. I said this all out loud, okay? And that was, I think, a 1 to 3 target, or 1 to 2. And then I convinced myself during this process that price will find some sort of resistance in and around this area and not continue down. And it did. It found resistance, as you can see here on the 1 minute time frame. And that influenced me closing the trade. Was that thought process correct? Well, the answer is no. I found reasons not to hold this trade. Maybe because I already had a 2R win, so this will be 3.5R for the day. Maybe it was an excuse not to hold the trade because I was fearful that it would reverse against me. What should I have done instead? Well, my initial thought was that now the candle is bearish. We have a nice lower high entry. Yen is strong. Pound JPY, USD JPY is pushing bearish. It will feel the wick is what I said exactly. What should I have done? I should have held the trade at least to fill the wick. Even if I didn't go for the 3R, I could have said to myself, I'm going for 2.5R. That's another 1R on top of this reward. And it makes a big difference. Okay, that's my next trade. If I lose, I'm only losing a 1R of my profit. The lesson here, guys, is there are going to be so many stories and narratives that you're going to create in your mind to convince yourself that if you do this, you're going to protect yourself against the worst case scenario. You just don't want to do that. Okay. Was I punished for that? You could say I was because I could have got another 1R from the market. I am grateful again that I got 1.5R, but I could have done better. So that's the lesson. Please, guys, make sure that you are focusing on setting a target. And once you've set that target and you have that in mind, just follow through. Because if you don't, then it means that you're going to be cutting your winners short and you're going to let fear take over and dictate your decisions. Now, the second rule that you must follow is do not go break even too early out of fear. Because, guys, moving to break even too soon is just another way of saying that you don't trust your trade. Okay, you've got to give your trade breathing room and you've got to let structure confirm before adjusting your stop losses. I want to share an illustration of that this morning as well. This, in fact, was actually the gold trade that I took again on the London Live with NDS. You can see really nice 1 minute structure here to the downside, lower lows, lower highs. We have a very nice double top pattern, which is a selling pattern. And we have the previous candle closed bearish in anticipation for the next candle to close bearish. Now, here's how I set the target for 2R. I said, I believe price can get back down to this low before we find a rejection. That's what set this up for a 2R trade. Totally different to what I did on Euro Yen, where I should have gone for this low here, and I didn't, and closed at 1.5R. And here I did set the target and I went for the 2R. So that's good. But in terms of going break even too early out of fear, you want to avoid it. Now, one thing that I've noticed in 2024 was that a lot of the trades that I took went in my direction. Now, they're not all winners, by the way, guys, but I'm just saying they went in my direction. Whether it's by 2, 3 pips, 1 or 2, it doesn't matter. It just went in my direction. What I tend, what I used to do was go break even at 1 to 1. And what I found often happened was price came back to stop me out just because it was going for a pullback and then continued in my direction. Now, this is not me telling you not to go break even at 1 to 1. This is me telling you what I have found with my own experience as a trader and through my own observations that when I go break even 1 to 1, price tags me out and then continues in my direction. So this is a fine example of this trade that I took this morning. Price went to 1 to 1. If I'd followed through with the 1 to 1 break even, I would have been stopped out at break even, and then price would have gone in my direction, and I would have never been able to hit that 2R. My advice to you is if you are observing that price is going in your direction, and based on your data and journaling, you are being stopped out at break even too soon because you're going to break even too soon and then continuing in direction more often than not, then you've got to change it. It's hard because you've now got to change a habit that you've been used to for so long. But if it's going to favorably have an impact on your trading results positively, then you've got to make those changes. And once you overcome the barrier of discomfort, you will start to find that it becomes a lot easier. But you first have to make the first step. So that was a great trade that we took. Didn't go to break even at 1 to 1. Set the trade to break even at 1.5, I believe. No, I don't believe. I don't know why. Oh, well, that line is there because I shared it with you. But 1.5 went break even and then obviously went for the 2R target. Okay? So great lesson. The third rule that you must follow is always enter, guys, on a pullback, not a push phase. I cannot stress this enough. The best trades happen, guys, when price pulls back to a key level or period pulls back to make a lower high, higher low, and not when it's already moving fast in one direction. Because entering on a push phase means you're chasing your trades, and then obviously that's how traders get trapped. So just to share an example with you on that, this morning, again on the London Live, it's crazy how all these lessons come up this morning, but anyway, this trade idea came off the back of price closing bearish, anticipation for price to continue bearish on the 7 o'clock candle on USD CAD. Now you can see the structure of the market is clearly to the downside, and we have what looks like a very nice downtrend. However, when you look at the structure, guys, we have a very strong pullback, and now we have a continuation of that downtrend that has just started. So this is a downtrend that has continued. If price pulls back here and continues down, or here and continues, we still have that downtrend. But once price creates those higher highs, higher lows, and continues up, we almost have an end to that downtrend, especially when you trade in intraday timeframes, because it is a short shift in behavior and not necessarily a change in trend from a higher time frame perspective. And if you're trading, let's say for 2 hours, 3 hours, 4 hours, you want to pay more attention to short-term behavior than you do want to be focusing on long-term trends, because it's not going to reflect on the lower time frames. But this was a trade one of my students was going to take, which was a sell. He decided not to take this trade. This is another good lesson, but this is not included in the 10 lessons. But let's highlight it. If he had taken this trade, he would have had to put his stop loss above the high, which was on the 5 minute time frame. So okay, let's illustrate that then on the 5 minute time frame. Okay, at the time, which was here. Now the range of this candle is around 14 pips. And the reason he didn't take this trade was because the average range of the previous candles, as you can see here, was 12 pips. And if we go over here, was what? 18 pips. So 18 or 19. 19 plus 12 pips divided by 2, do the maths, is definitely around the 14 pip range, which means that if he entered this trade, he would have had a stop loss size the average range of the previous 2 or 3 candles, which means that if he wanted to sell this, he would have then needed this candle to push 1 to 1 to be average range and then continue to push further down and exceed that average range when there is no history of that volume in the market at this moment in time. Now there's history. You can see the range has increased, but there was no history. So he decided not to take that. But anyway, besides the point, let's go back to the 1 minute time frame. You want to be entering on a pullback, not a push phase. This is a push phase. Yes, this may look like a lower high break of the low, but what you have to understand is that if price pushes, it will pull back before it continues down. Exactly what you can see has happened here. So the best case scenario for you to have entered this trade would have been for the previous candle to close bearish, the new candle to have opened, created the top wick, and then created a range back down to the low, which would be the push phase, to then give you a favorable 1 to 2 risk reward ratio trade. Once it gets here, we wait for the pullback again, and then we look for the continuation sell. And when it pulls back to around this range here, what you're then looking for is for price to get back down to this range for management in anticipation for a continuation. That didn't exist. So he avoided this trade because of that reason. So please bear in mind, guys, enter on a pullback, not a push phase, because when price pulls back, it gives you a bigger range for price to continue to push down, giving you an opportunity to manage the trades and get a better risk to reward ratio. Okay. So the fourth rule, fourth lesson. We've spoken about this before in my previous YouTube video, but you must identify 2 or 3 patterns and stick to them, guys. I cannot stress this enough. And I believe I keep saying this, but more setups do not mean better results, right? Trading is about mastery, not variety. So find 2 or 3 high probability patterns that work and execute them with discipline. So to illustrate that, we're going to go over to pound JPY. Now I want you guys to look at this pattern here. This is a very strong push phase, a very nice clear downtrend on the 1 minute time frame with a very huge exhaustion. Now let's go back to the previous lesson. Do not enter on a push phase, enter on a pullback. This is a push phase. Price is now in a push phase. No structure here to work with in the sense of a trend, but it is a push phase. So you wouldn't take the trade in anticipation for price to continue bullish, wherever you put this, doesn't matter, because what do we expect? We expect price to pull back. So that being said, we want to make sure that we have 2 or 3 patterns that we can trade along with the rules that I'm sharing with you today and bring them together to create favorable ideas. So now that I know this is a strong pullback, I also trade patterns where price is failing to break the structural high. So we have an area here where price has created a high. We can see price failing to break the high. That being said, I can just call this a double top. It doesn't matter, or a reversal pattern. I can also see this is in a push phase, meaning I don't believe this is going to continue anymore without the pullback. And then to make this a favorable trade, I need to make sure that in the past this has happened before, so that this now becomes a trading pattern that if I execute consistently will give me a positive return on my investment in the future. So if I go over to USD JPY, I can see here, this is current, that we have an area where price has created a structural high, price has pulled back into that structural high. We have a very strong push phase. You do not enter in a push phase because we expect a pullback. I can see here around 743, 745. I can see here around 743, 745. Price is failing to break, failing to break. So now we have congruent behavior in the market. With the pattern that I have, which is a double top push phase, I can comfortably take this trade knowing that if I execute this consistently in the long run, it's going to give me favorable results. Here's this example, and here's this example, whatever. So now we've just created one pattern that we can trade consistently as per our process or trading plan, whatever you want to call it, knowing that if we do this and follow the plan, we will get results in the long run or short run, whatever it may be. Okay, this is one pattern. I'm not going to go for another two. The previous YouTube video shares those with you, some ideas. Okay, but this is one pattern, and this is what you want to be doing. You want to make sure that you identify 2 to 3 patterns and stick to them. Okay, the fifth rule: understand candle ranges, guys. If a candle closes with a large range, the next one is more likely to pull back first before continuing, right? Small ranges signal indecisions, meaning that there's no momentum yet. So you've got to learn how to read price movement within the candles. So I'm going to illustrate this here, all right, on USD JPY. Let's remove this here and let's focus on this. Now, this candle has closed bearish. I'm anticipating the next candle to continue bearish, right? However I get into this trade is how I get into this trade. But I'm anticipating price to continue bearish. That being said, if I'm looking to take this trade, just because price is pushing bearish here and the candle is bearish, the trend is now to the downside, creating lower lows, lower highs, double tops. Let's continue to identify these patterns: push phase, pullback, lower high continuation, push phase, lower high continuation, whatever you want to call it. It does not mean that I should be entering the trade here. A pattern is very powerful, but what you must also identify is your candle ranges. So these are 2 favorable patterns here based on a trend to the downside on the 1 minute time frame, but it's certainly not favorable based on candle ranges. Okay, so what do I mean by that? Well, every candle has a range, guys. Every candle has a range. And if price is already pushed bearish, it means that there's a very high chance you will enter in the trade late if you were getting in at the bottom. The most favorable time to get into a trade is at the top. Now, you can trade all the way down as long as structure is providing that for you and you believe that there is still range to the downside. But if we look at this from a 1 hour perspective, this is where we anticipate price to come into before reversing, because this is a wick rejection area, support area, reversal area, whatever you want to call it. Here is where price creates the top wick and flips bearish in line with the previous candle. Just because this is a lower high or this is a lower high doesn't mean I should be entering the trade, because if I enter down here, I'm entering at the bottom of that 1 hour candle, meaning the candle range is exceeded. So what I prefer to do, or what I encourage you to do as a rule, is always enter the trade as close to the high as you possibly can with favorable structure. So in this instance, this is a lower high, double top pattern, so that you can now take advantage of that range back down to the low, as you can see here. Hit your TPs and exit the trade, because there is a much higher chance price will reverse. Okay? So understand candle ranges. It is such an important rule. The 6th rule is this: structure is your friend. The market leaves clues with higher highs and higher lows. That's all I'm going to say to you, right? And you can work with key zones. So if you're ignoring structure, guys, which I'm sure you're not, but you've got to understand it a little bit more clearer, you're guessing. That is all I'm going to say. You're not trading, you're guessing. So always trade with market structure, not against it. To illustrate that, let's take a look at Euro USD. We can see here that on Euro USD, price is pushing bullish. So with the 2 candle theory, it is bullish candle, bullish candle, bullish candle, bullish candle, until we exceeded the range and then we anticipate a reversal. Okay. But That is the core principle of the two candle theory concept and the belief you must hold on to. But look at the structure on the 1 minute time frame. Price is pushing up. We have a very nice trend to the upside. Price has not broken the trend line for a very long period of time. So every time price comes back to this trend line, this is a trading opportunity for you. In theory, okay, here's a trade, here's a trade, here's a trade, here's a trade, here's a trade. Okay, look at all these trades on the way up. Why? Previous candle closed bullish, next candle will be bullish, next candle will be bullish, next candle will be bullish until the market tells you otherwise. Plus, the structure is telling us what it's doing. It is going up. So you've got to listen to it, guys. Now, when we see this, all we've got to do is have complete belief. Because if you had entered this trade on the way up, you would have won a trade or two. Now, that being said, if I can see this is going up, then I'm looking for favorable structure to work with. Okay. So let's just go to recent history. If I go over here and I can see price has made a double bottom, we have a nice push phase, we have a higher low. Is this not a trading opportunity? Of course it is. Why? Because structure tells me it is. Okay. Structure tells me it is. If I see price coming back to this level, is this not a favorable opportunity? Of course it is. Structure is telling me so. Okay, let's move this over here because I think I'm in the way. Right? Structure is telling me so. If I see price coming back, creating a break of the high, higher low, break of the high, higher low, is this not a favorable trade? Of course it is. Why? Because price is telling me. There's nothing difficult about that one, guys. Okay? So you've got to understand that structure is your friend. When the market creates those higher highs, higher lows, fail to break the low, fail to break the high, it is an opportunity for you to get into the market. If we take a look at USD JPY, is that not a failure to break the high? Sells. Is that not a failure to break the low? Buys. Is that not a failure to break the high? Sells. Is that not a failure to break the low? Buys. Okay. I'm not saying this is 100% going to work every single time, but you don't need it to work 100% every single time. You just need it to work enough so that you can allow your edge, which is your risk to reward, to work in your favor. Okay. The seventh rule, use currency strength to your advantage, guys. I cannot stress this enough. There is enough videos on my channel talking about currency strength and weakness, right? Strength and weakness drives momentum, period. If a currency is weak across the board, you're going to have a higher probability of price continuing in that direction. Don't fight the trend. Use it to stack the odds in your favor. So to illustrate that, let's look at GU. Okay. We can see here that previous candle closed bullish, next candle bullish. We have structure here where price is still trending to the upside. We have this downtrend. We have this break, this low high. Now we have the higher low. So we're changing structure here on the 1 minute time frame. Is that enough for me to get in the trade? Could be. But if I want to add confluence to this idea here, then what I could do is go over to Aussie dollar USD and I can say to myself, well, around this time, which is 8:16, am I seeing 8:16? Am I seeing the same behavior? Well, in order for USD to be weak, I need price to go up. Okay. So here price is pullback, created whatever, doesn't matter. Now we're pushing bullish. Here we create some sort of high low formation, and around 8:23, we continue to push bullish. For GU, I need price to continue to push bullish in order for USD to be weak. So look here. Around the same time, we can see price pushing bullish. Let's just make sure this is correct. Yeah, around this time, right? So it's 15, 16, 17, 18. Now we can't enter this trade here on GU, or sorry, AU, because we're in a push phase. But if I go over to GU and see around 14, 15, 16, 17 that we're pushing bullish, and I can see a higher low forming, which is structure. We see a trend change. This is a pattern also. And around the same time, 14, 15, 16, 17, that there's an opportunity for me to take a trade based on that higher low breakout with the behavior support in USD weakness, AU pushing bullish, meaning GU should push bullish. Then now I'm using currency strength to my favor, in my favor, because I know even though GU hasn't yet pushed bullish, AU is leading that behavioral strength, indicating USD weakness around 13, 14, 15, 16, 18th minute, because it's already pushed bullish. Let's look at that. Already pushed bullish, meaning that there's a very high chance based on the pattern, the structure, the formation of the previous candle. This is a wick entry, higher low, that this could go up. I don't need it to go up every single time. I just need to know that there is a higher chance that it can go up long term then a lower chance that it won't favor me profitably. So you've got to use currency strength and look for clues, guys, so that you can get an advantage in the market. Okay. The eighth rule, guys, use wicks as clues for market direction. Wicks tell stories. As long as a long wick, guys, rejecting a level shows buyers or sellers stepping in. Simple. A clean candle close signals momentum. So a quick wick and a flip signals momentum. So instead of reacting emotionally to the market, let the market show its hand first. To illustrate that, let's look over here. Okay, this is Aussie dollar USD. We can see that price closed bearish, anticipating price to continue bearish. Let's move over here to continue bearish. Price did continue bearish. Fantastic. So now we have evidence that the two candle theory is a very powerful concept, and we could have got into that trade given the evidence that it developed. However, on the close of that candle, what can you see? Price rejected majorly. There's a huge rejection. That means that that buying pressure is depleting and that bearish pressure is entering the market. Now, is that enough? Well, no. We need to understand why that's happening. Oh, look at the past. Price failed to break. We're seeing evidence of that again. And that leaves a clue. The clue is there is a very high chance that buyers are stepping into the market, sellers are depleting. That push phase needs a pullback. The structure now starts to shift on the 1 minute time frame. The wick left a clue. The pattern develops, and now we can look for, let's say this is the cleanest high or low in this formation. Oh no. Let's look for something like, there you go. This is just part of the same candle, right? Below the wick, 3 pips, whatever. There you have it. Wicks leave clues. Understanding the behavior of the market, identifying a pattern where price failing to break below or above, identifying a shift in market structure on the 1 minute time frame, understanding that if there's a strong push phase, price cannot continue down before a pullback. Everything's pulling together, guys. These 10 rules I'm sharing with you right now, I didn't just make them up. These are not baby pit rules. These are real life experience rules that you will only gain the knowledge from by being observant with your trading behaviors and your patterns. Okay? So use wicks for clues for your market direction. Number 9, higher time frame bias is key, guys. You got to use at least the 1 hour, 4 hour time frames because they control the market flow, especially for an intraday trader. Right? If you're trading against them, you're fighting the bigger picture. So to make your job easier, guys, you've got to align your concept with the higher time frame direction. So that being said, let's move over to Swiss franc. Now, as you can see here, I've popped in on the 4 hour time frame few black lines. Okay, you're seeing this. What we can see here is that, let's say I come to the markets at 6 o'clock. I plan to trade for 2 hours. From 6 till 10 is when this 4 hour candle is open. If the current 4H candle is bullish in this instance or illustration, then I want to be making sure, because I have a strong belief it will close bullish, that I'm trading bullish. That is the market direction. This is what I'm talking about here. Okay, this is a higher time frame bias. That being said, I've dropped in my lines. Now, once I drop in my lines, what I want to do is go down to my time frame. This is not a strategy, guys. I'm just trying to illustrate something here. It is a strategy, but I want to illustrate this here to you. Once I drop down to my lower time frame and I come to the charts, I want to make sure that I'm trading in line with these black lines. That's it. Pure and simple. Okay. I want to be making sure that I'm trading in line with these black lines. So that being said, I come to the charts and I see this candle's closed bullish. I'm trade from 6 o'clock till 8 o'clock. Now, we didn't take Swiss franc JPY this morning because we took gold and we took euro yen, and plus we don't trade this pair either. However, the point is this, I know that I must be looking for buys. So on the 1 minute time frame, the overall structure of this market is illustrating a bullish structure. The previous candle closed bullish. I'm expecting the next candle to go bullish. The higher time frame bias is currently bullish in terms of behavior. So that being said, I'm going back through my rules again and I'm looking for supporting evidence. So however you do this, you can look for the breakout of this trade here. If you're a breakout trader with a stop loss, let's just say below 7 pips comfortable, and you can say to yourself, I'm going for my 1 to 3 targets. Here is your trade. Okay. You can say to yourself, well, I'm not a breakout trader, but I know the high time frame bias is bullish. The previous candle on the 1H time frame closed bullish. The next 1 hour candle will be bullish. It's created a wick and it's flipped bullish. And I'm focusing on my patterns, which is a double bottom or a break and retest. And here we have an illustration of that double bottom. So this is how I'm going to take this trade. Okay. Let's just go for 8 pips. Doesn't matter. All right. And now let's just say you go for your 1 to 3. We're going to win this trade because we've done enough work on this session to deserve it. Okay. There's your trading opportunity. And what I want to continue to do is until that 4-hour candle closes, I want to just keep buying. As long as there is no structure in the way that is going to cause me problems. Remember, overextended resistance levels in the market, wick rejections in the market, blah, blah, blah. If I'm taking this trade, I'm anticipating prices at least get back to this high. Maybe with the 1 hour time frame to support that, let's say we can get back to this high. Okay. We might look for some management in and around this area because we've seen price react to it before in the past. It is a little bit back, so maybe we wouldn't focus on this, but we're not here to talk about this. So that's where I'm anticipating price to go. So that being said, any opportunity that I get that looks and resembles like that it's going bullish, then I'm going to take that trade. And here are 2 illustrations of that. Okay, so that's rule number 9. High time frame bias is key. Now, the final rule here, guys, is don't chase. Let the trades come to you using the 9 rules that I've shared with you, plus this very, very, very important ending. Okay, one of the biggest mistakes that you can make as a trader, guys, is chasing price after seeing momentum in it going in your direction. Okay, it's the emotional reaction of, oh damn, it's moving without me, I have to get in before it's too late. But guys, in reality, chasing an entry does more harm than good. Okay, and here's why. Poor entries and poor trade management. I keep looking at myself because I have no one else to look at, but when you enter a trade late, you are often getting into a worse possible price. Plain and simple, right? Your stop loss needs to be wider. Your risk to reward then becomes unfavorable. If price pulls back, which as we've seen today, it almost always does, you're likely to get stopped out before it continues in your original direction. And long term, that is going to work against you. The best traders don't enter out of FOMO, which is fear of missing out. They enter because price came to them at a logical level that makes sense. Okay, the second reason is impulsive entries lead to emotional trading, period. If you jump into a trade impulsively, you're no longer trading your plan. All right, you're trading based on emotion. Right, you're going to constantly be checking the charts. You're going to panic if price is retracing. You might close a trade early because of fear of insecurity, whatever it may be. And I want you to compare this to waiting for price to come to you. When you enter calmly, right, knowing that the setup aligns with your edge, then you execute without hesitation. So why do the opposite? Okay, why enter impulsively? The third thing is this, right? The best trades always retest. Remember this, or make lower lows, lower highs, or fail to break highs and lows. So you've got to be patient. And I want you to think about the best setups that you've ever taken. Most of them didn't just fly without giving you the opportunity to enter properly, right? Price, it pushes, it pulls back, then it continues. And this pullback is where smart traders enter, while traders who trade based on FOMO get stopped out. Okay, so if price is moving too fast and it doesn't pull back, just let it go, right? Chasing one trade is never worth breaking your process. The final thing is this: the right entry sets the tone, guys, for your whole trade and career, if I'm honest with you. Okay, your entry is the foundation. If you get it wrong, and everything else becomes harder. So with the right entry, you can hold with confidence. With the wrong entry, you constantly want to close, manage, and move your stop, whatever it may be. So instead of saying, I need to be in this trade, I want you to ask yourself, would I still take this entry if price was moving against me instead of in my favor? Right? Am I entering because, it's my setup, or because I feel like I'm missing out? If you feel the urgency to jump in, then guys, that's a red flag and you're about to chase the trade. So please, please stop it. So those are the 10 rules, guys, why my trading went from inconsistent and frustrating to predictable and profitable. And I don't want you to be the trader that continues to do the same things and not identify these rules so that you can level up. So if you enjoyed this video, make sure you watch it one more time. Hit that like button for me, guys. Subscribe if you haven't already. Turn on notifications. And until the next one, take care.